When you're investing in a business, it's one of the most challenging decisions you're ever going to make in your financial life. It's generally going to be much higher risk than investing in a conventional asset such as stocks or bonds. It's certainly not going to be as liquid. One of the first things to do when you set out to potentially invest in existing business is understand why that you're doing it. Maybe you're doing it because it's simply an opportunity that you want to be involved in. Maybe this is your way of effectively buying yourself a job. Nothing wrong with that. Maybe it's a purely financial investment and you don't plan to participate in the business at all. Whatever the reason, make sure that it's clear, because understanding why you're investing in this business or in any business at all can help inform the subsequent decisions that you have to make down the road. I'm assuming that if you're watching this video, you've already found a business that you'd like to invest in and you're looking for tips on how to proceed. One of the first things you need to do is something called due diligence, the process of examining a business to identify its strengths and weaknesses, as well as the opportunities and threats that are posed by its industry environment, so that you fully understand the totality of the business, especially its risks. You can't possibly make an informed decision about buying a business if you don't understand the risks. And the due diligence process is designed to make sure that the business's risks are made clear to you. Once you understand those risks, and if you are comfortable with them, the next step is to understand the value, because you may be making an offer to buy in the business, or you may be being presented with terms by which you might invest in the business. Either way, one of those terms is going to be the price. And you should know whether or not the price that you're prepared to offer or the price that you're being asked to accept is consistent with market terms. Now, maybe you decide that you're willing to overpay or underreceive for a business, and that's okay, as long as you know that you're doing it and you have a specific reason for doing so. What's not okay is to overpay for a business and then only learn a year later that you paid much more for it than you should have given the risk profile. The key to good due diligence and the key to a good valuation is to ask a lot of questions and get outside help. Many accounting firms, law firms, and specialty firms will help you with the due diligence, and valuation firms such as High Score Strategies will help you determine the appropriate price to pay and how the terms of the acquisition might impact the price that's appropriate for you. Now it's time to negotiate. And you have to negotiate two things. Many people make the mistake of negotiating solely on price. The importance of price can be outweighed by the terms of the actual investment. For example, when you're making this investment, are you getting common stock? Are you getting preferred stock? Are you getting control of the company in any way? Do you have board representation? Do you have veto rights over certain activities of the company? If the other investors decide to sell their shares, do you have the right to go along with that transaction? It's called a drag along right. What are the buy sell provisions? If you decide that you want to be bought out, or if conditions arise that require you to be bought out, how is that buyout process going to be determined? How is the price going to be set? How is the purchase going to be paid for? All these things should be considered and set forth in the purchase agreement. I helped one client buy a business because he wanted to attach it to the business that he already owned. We were able to help him understand the value of the business. We were able to help him understand the risks, but also in talking to the seller, we were able to gain an understanding of what the seller's priorities were. And it turned out the seller's priorities were simply to raise cash because they wanted to put money into another venture. And so the seller's objective was not necessarily to sell their share of the business at the highest price, but rather to raise a certain amount of cash quickly. With that in mind, we were able to structure a deal where the acquisition was very affordable, the seller was very happy, and this acquisition wound up being a platform to that client acquiring several more businesses and is now positioned for a sale of the total business in excess of $100 million. When somebody asks me about investing in a business, I then ask a few questions so I can understand their thinking better. First question is, what is the business? And how well do you understand it? A great way to lose your money is to invest in something that you don't understand. That doesn't mean that you can't acquire that understanding over time, but it's critical that before you decide that you're going to commit your funds, that you understand exactly what it is that you're buying. I ask them why they're thinking of making an investment in the business generally. Why would they want to do that instead of investing in a more conventional asset such as stocks, bonds, or real estate? Ask them about their relationship with the founder or the existing owner of the business, because once you buy into the business, you're going to become a very intimate partner. How well have they known each other? Have they ever had any conflict? And if so, how would they resolve it? How have the negotiations gone so far? What have their instincts told them about working with this person? Have they talked to other people that have worked with this person before, maybe employees, former employees, customers, capital providers, to get a sense as to what it's like working with that person? What are the biggest concerns in my client's mind? What are the risks that they're most afraid of? And then we'll talk through it to see if those risks are manageable in some way. And then, of course, I'll ask, what is their view on how much the business is worth? What is their view on how much a share in that business is worth? The two most frequent mistakes I see when people invest in businesses is one, they don't do enough due diligence. They feel time pressured, or they're not focused enough on due diligence, or maybe they're dismissive. They don't want to spend the money. And that's where I've seen investors profoundly regret how they approach that investment. They think they have more expertise than they actually do, and they think they can do it themselves. Or they simply decide they don't want to spend the money, which is curious because they're willing to make a multi-million-dollar investment, but they won't spend a few $1,000s to protect that multi-million-dollar investment. And they say, if I had to do it all over again, I would have spent more on due diligence. The second regret is I paid too much. The valuation was much too high, and now it's going to be very difficult for me to achieve a return on my money. So what caused the bad valuation is that the buyer didn't want to pay the fee, and they didn't really know about the kinds of information that business appraisers can provide. We have access to transaction data that gives us insight as to what the market is for particular companies. We have insight in terms of how a company's risk profile should alter its pricing in the marketplace. Because this investor did not have that information and expertise in their disposal, and they chose to make an investment without the benefit of that knowledge, they wound up making a significant mistake. It can be because they're emotional. Sometimes people don't do their due diligence because they just want to buy, right? They're just excited and they don't want to hear the bad news. They don't want to have to start over again. That's the way deals can go. Buyers can sometimes become so invested in the deal process that they lose their objectivity. There is a timing factor that maybe there's impatience, but more often the seller has led the buyer to believe that there's a chance they'll miss out, that they've got other buyers who aren't going to be as insistent upon due diligence, and therefore if you don't want to buy right now, that's fine. I've got three other people that want to buy right now. To my mind, the answer to that question is good luck. Thanks for the opportunity. People aren't always rational. Classic FOMO, right? They assume, well, all these other people are excited about the business, it must be really good. Never mind the fact that those three buyers may very well not exist, or two of them are like the owner's kids. The third one is like their cat. One of the things I can do is to be a useful backstop on your due diligence. Due diligence is hard. It's easy to miss something. And especially if you decide to do it yourself, it's helpful to have another set of eyes on it. In point of fact, I like to think of our valuations as incorporating due diligence, because our job is to try to anticipate the most likely price that would be paid by a buyer and accepted by a seller, which means that we have to ask most, if not all, of the same questions as would be asked in a due diligence exercise. So if you're thinking about making an investment in a company, whether it's an active or a passive investment, contact us. At a minimum, we can give you peace of mind. And at best, we can help you maximize the return on your investment.